Well, hello everybody, and thank you for joining us for, one of these regular webinars that we do. And we try and find boutique topics that fit our client. And our client is typically the private developer and the private apartment owner. And oftentimes that private apartment owner is in a multi-family generational situation. And this is a very, very timely topic that we're doing today on multi-generation families and using estate freezes. I'm going to introduce Trevor in a moment. He's a good friend of mine and a tax lawyer and has a deep understanding of this space. And while this is complex, you can take complex things and have people understand them and make them relatively straightforward for you. So we're going to be talking about something complex today, but we're going to, dumb it down so that it's understandable. And then if this makes sense, you can talk to Trevor and people like him about actually executing, right? So what we're talking about here is transferring growth into the hands of your children and your estate and so on, okay? And we'll get into it. We've got 10 questions to go through and so on. Just a reminder that we've got a couple of events coming up. December 2nd, as part of Toronto Real Estate Forum, is our full day annual conference. Rod, I think this is year 15 that we've done this, okay? And we've got a full slate of speakers there. So if you're in the apartment development industry or tangential industry related to that, this is the place to be. And it's on December 2nd at the Metro Toronto Convention Center. Every year for about as many years, we've been doing what we call the apartment kickoff for 2026, where we're gonna bring on some, we're gonna come on and we're gonna bring on some guests and we're gonna talk and prognosticate a little bit about what's gone on and what we think is going to happen in 2026. And so you can join us. That's a free webinar when everyone's back to work after the holidays. Okay, so I see lots of people here that we know that are regulars. Rod, let's get started. If there are any questions, put them in the chat box. We got a pretty full session here today, but something comes up that's answerable, then we'll try and answer it for you. Okay, keep the questions fairly short and specific. So Trevor Parry, Trevor, that's an interesting background you have there. In the day, Rod, when everyone's got a fake background in some kind of office, Trevor, this looks like, I don't know, a combination of a man cave, a junkyard, and a history library or something like that.
Yeah,
Welcome.
my daughters counted the books in here one time, Derek. There's just over 3,000 of them.
Right.
It's like a crazy professor's office.
Yes. Trevor is a tax lawyer, but also just a keen intellect. And oftentimes when we're talking and we meet for breakfast quite regularly, I have to get him to define the word that he's just used. So I always come away with not just good information about real estate and taxes and so on, but also just I leave with a better vocabulary. Trevor, welcome, my friend. Let's just get started, okay?
Thank you, Derek. It's great to be here.
Okay, so we're talking about, estate freezes, okay, and advanced tax strategies. But Trevor, first of all, is the estate freeze a complex thing or is it a common thing?
It's a common thing, Derek. We're seeing them more and more these days, and we're going to get into the why. The complexity comes from the number of variables or pieces that go into a freeze. But in essence, it's not that complex a strategy at all.
Okay. So spoiler alert, here are the questions that I'm going to try and get through with Trevor. We're going to go through these one at a time. And okay, so Rod, let's get going to the next one. So Trevor, just simply, what is an estate freeze?
An estate freeze, Derek, is a reorganization of a corporation and its share capital that is basically going to freeze in the hands of one generation the value of that organization at a time, and then pass all of the future growth into future generations' hands. That, in essence, is what this thing is.
Okay, so I own a bunch of real estate. Fair enough. And
right.
Upon my death, there's going to be a big tax bill, right? So at some point, I say to myself, I want to just freeze this, pay my tax, and I want to transfer it to my children so that instead of having 20, 30 years more to run, it's got 50, 67 more years to run before the eventual tax is paid.
Exactly. I mean,
that's essentially it.
That's it. You've nailed it.
Okay. So what are some of the key characteristics of a estate freeze?
Okay, so when we start, we look at what's the organization look like, who are the shareholders, who are the founding generation, all that kind of stuff. And the most important thing, particularly in the real estate world, and I pound the table, is value, value, value. You have to be on top of the values of the relevant properties, and then you look at the corporate structure. So the first challenge is making sure that everything is in a corporation, where we get into discussions about land transfer tax and all that kind of stuff.
Sure.
But the key is, let's look at the battlefield. What is the value of this company right now, and then what's the growth prospect look like? That's going to determine when we pull the trigger on a freeze and what that freeze is going to look like.
Is there a lot of strategy involved before you do it, or is it one
There's
size fits all?
No, it's not one size fits all, because you're going to find, based on their industry or their profession, the freeze looks a little different. So for a family real estate company, simply because we probably have multiple projects, multiple properties, we are going to have multiple corporations and multiple classes of shares. So there's just more moving
Right.
parts. Whereas if it's a dental corporation, there's one or two shareholders and it's easy peasy. So it's just simply the inputs that go in that make it complex.
Okay. And a lot of times people will own a building in a separate corporation, so there's just more to do, but you're replicating the same thing over and over again.
Exactly. I mean, if you have, one project, or you may have a joint venture or something like that, you're going to keep those in their lane, but they're all going to be, at some point, again, you're going to crystallize, you're going to freeze.
But in a nutshell, future growth is in your descendants' hands.
You got
That's
it.
why you're doing this.
Yeah.
So you're
Right.
doing
But
your kids.
sorry,
Go
Derek,
ahead.
the critical thing when we get into how they get structured, yes, you are going to pass the growth into the hands of your kids, but you're not going to surrender control of the enterprise. That goes to how you draft the shares, but you maintain control the whole time.
Right. So I'm giving the apartment buildings to my kids, but I'm still the boss.
You got it.
Okay, next slide, Rod. Okay, so why should I consider a freeze?
Simply, Canadian tax rates are onerous. If we look at even capital gains rates, the effective tax rate is 27%. So people have to have an eye towards that. Future planning, if you neglect what happens, and this is way well down in our conversation, there's the potential that you can have double taxation. So you always want to avoid that. You want to be able to defer that capital gain in the hands of not just the founders, but also into the next generation. So time in tax is always money in your pocket, right? So the ability to defer, and then set up an orderly intergenerational transfer. So the kids who are going to participate in the company get control of the company, but we're able to create, an equalization formula for those who are not involved, so that you get an equitable estate transfer. And then something that's actually so critical, it's probably one of the very few things in the last, not this current budget, the budget was the last Trudeau budget, was they increased the lifetime capital gains exemption. And a lot of the times I find that family real estate businesses don't sell, but you will find projects selling. And if you, in your freeze, set up the structure correctly, you're going to be able to have each shareholder, directly or indirectly, claim that exemption. It's $1.31 million and goes up every year.
So you can use that now.
Well, you can lock it in certain cases. So some of the council I will work with will crystallize the capital gains exemption. Often what we do is we leave it, and we do it at death. We'll claim it at death. But again, it's 1.31 million in 2025 for each shareholder. And part of what we do with a freeze is, when we transfer up the growth into the next generation, we're going to multiply that exemption. So if you got 5 kids, that's 5 times 1.31 million of tax-free dollars on the sale of a company, if it meets certain criteria.
Right. That's one more question. Does that also extend to your grandchildren?
Yeah. Oh, yeah. Absolutely. So this is where we end up using family trusts, because it's in there, but basically you multiply the exemption for all of the trust beneficiaries.
So if you got a big family, right? So I have 3 kids and 14 grandchildren, right? So I got like $20 million in exemptions here.
Well, some of your grandkids are south of the border, so you have some withholding tax issues, but I can help you with that. In essence, yes.
Very good. Very good. Okay, good. Okay. All right. So why is now the right time to consider a freeze? Like you could have done that, you could have done it in the past, you can do it in the future. Why would now? Because we talked about why is the right time to do a freeze?
Now is the critical time, Derek. So Rahm Emanuel, who was the chief of staff for Bill Clinton, is famous for saying, "Never let a good crisis go to waste."
Yes.
All of my friends who are involved in the real estate world are bemoaning the current state of the market. And things are slow, the values are down, and that's the critical thing, is that by locking in depressed values in an estate freeze, you are going to reduce the tax attributed to the founding generation. So there is just a clarion call right now to reduce your taxes through a freeze. So you want to take advantage of this depressed market, and hopefully in the next couple of years the ship rights itself, but you will have done the work now, which will pay off handsomely down the road.
Okay. So pick the low water mark,
You
and
got it.
that's the time you do your freeze because your kids will pay tax from that, like from that point on. Well, you
Oh,
pay less
and
taxes.
yeah, and
You're
Derek, what
paying less
happens
taxes today.
in a multi-generational family real estate business, there's usually more than one freeze, because the next generation is going to go out and freeze for in the benefit of themselves and their generation as well.
Right. Okay. So if we think about real estate, apartments, have done probably the best of all the asset classes, right? So
Yeah.
cap rates have compressed, I don't know, from maybe, or they've expanded from maybe 3.5 to 4.5%. Fair enough. Okay. So had you done a estate freeze a couple of years ago, the appraiser might have come back at 3.5%. Today he's coming back at 4.5%. So that's the reason you're doing it now. Fair
Yeah.
enough. Okay.
Right.
Now the biggest drop has occurred on land values. Okay. So land that was $100 per buildable foot is now $50 a buildable foot. Okay. Now let's assume it's going to go back up to 100. Can you do the estate freeze on land also?
Well, if it's in a corporation, sure.
Okay.
Yeah. So because the value of the land is reflected in the value of the shares.
Right. I guess the point I make, I never thought of it before, is that if you were to like if people are going to have multiple corporations, fair enough.
Yeah.
If you were going to do it on anything, you would do it on the asset that is the most depressed in value.
Mm-hmm. Yeah, exactly. I mean, there's accounting issues whether the land is inventory or is it capital property and all that kind of stuff, but not germane to our conversation. But yes, absolutely. If it's in the corporation, then it's not the land you're not freezing the value of. It's the shares that reflect the value of the land that are going to freeze.
Okay. But if you were going to do a freeze, philosophically, do you do it on everything all at one time, or do you phase it in, or how's the thinking? Because a lot of these people are going to have 5, 10, 15 corporations.
You're more than likely going to do everything, but again, the bigger the organization, timing is going to come in. There may be assets that don't reflect a time to freeze, and you might leave them alone. But what I'm seeing most of the time is everything's freezing.
Okay, but the long and short of it is now is the time to do it because values are down,
Yeah, it's
and
never been
right.
better. I imagine 1989 was great too, but now
right.
is
It's the most
perfect.
tax efficient.
Yeah.
Yeah. I think we're going to answer that question that just popped up in a minute. Okay, so how do you implement this? Rod, next slide, please. How do you
After
implement?
that, okay. So if you want to jump to the next slide, it's wordy, but this is the timetable. So, folks,
Okay.
it's not as complex as this. This is there, for your review. I've seen freezes done quickly in under 60 days, but we're in the normal course of things. You're doing this over the course of half a year. So the most important thing is to get the right team to help you advise you so that you'll be able to understand what's going on. And then we start talking about valuations. Valuations, in particular in the real estate world, as you know, it is the quintessential factor. So you're going to retain the CBV, the qualified business value or certified business valuator.
So we call that guy an appraiser, an AAIC appraiser in our business. Yeah.
You got it. So all my accounting firms have them, and so they're going to come out and do the valuations, because that's the point of weakness from a CRA perspective. And lawyers going to build in all kinds of wording for price adjustment clauses and all that kind of stuff. But then they're going to start putting together with the accountant and the valuator, the appraiser. They're going to start putting together what we call a step memo, and it's just that. What are the steps that need to be implemented to freeze the value, to move properties around, so we take advantage of rollover rules and things like that. And again, depending on the complexity and the size of the organization, there will be inherent complexity in the solution. But there is definitely a timeline, and methodically going through that and making sure your documentation is all tickety boo. That's the critical part. But these are so commonplace, particularly right now. I mean, 60% of my business is either implementing or advising on or doing the post freeze planning for largely real estate right now.
Okay, all right, okay. So on the valuation side of things, typically when you're getting a valuation, you're trying to get the highest valuation, either for financing or for sale or something like that, right? Here, you're actually pushing for a lower valuation as much as you can control it. It's the
Yeah,
opposite
exactly.
of what you normally do.
Yeah, exactly. I mean, your appraiser is going to know how far they can, they're going to follow standard operating procedures, but lower is better in this environment.
Yeah. Okay. All right. Great. Great. Okay. So, okay. Next question. So, the Income Tax Act, what sections and options do you have, right? Like, what's the mechanism?
Okay, so there are primarily three. I've seen freezes where all three get used, and we don't mention 51 here because that deals with convertible securities and things like that. It's really two. It's Section 85, which most people are going to know about. That's the rollover rules where you're rolling, for instance, if you have land that is owned individually and it's going to go into a corporation, you're exercising under Section 85. You may move, certain, other properties or values in that's referred to as boot. That's really the motherhood section for this. And then often we're going to find that Section 86 is used. 86 is easier. And 86 is basically share exchanges. So if you already had, if you were unfreezing or you have several classes of shares and you want to exchange those simply for other classes, they could be freeze shares, you're into Section 86. But routinely you see both of those sections used. And as I said, Section 51 is another section. It's fairly nimble, but it's used when we've got convertible shares. But those are the big two.
Okay. All right. Okay. All right. So let's. Okay. So that's as much as we need to know, right?
Yeah,
So
the lawyer retained they'll give you all the verbiage. I mean, I joke, you've seen my memos and I've got them down to about 8 pages now because I can't sign my name in less than 2 pages. But
right.
the reporting letter on a freeze is going to be a good 15 pages long.
Okay. All right. Okay. Good. Good. So what are the pitfalls to watch out for?
Primarily, it's getting your valuations in order, right? So
Okay. Let's
that's
talk
always
about
the
that. Yeah.
critical thing. That's where CRA will come in almost always and want to review because you're creating a tax benefit by having a low valuation. So you want to make sure that all the T's are crossed and I's are dotted, and that their lawyer has built in mitigation factors, so price adjustment clauses and things that into their documentation. Some of the other stuff we see, if you are in a business that could potentially sell or part of it sells, you may have a development, your intention is to not sell the asset, but sell the corporation that owns the asset, then we're into the lifetime capital gains exemption. So you have to be aware of that. And there was a question in there about, can I explain that exemption? And I'll do it really briefly and try not to be too
Okay.
complex. And I'm not going to use any acronyms. So when you sell the shares of a corporation, everyone thinks they're going to get this $1.31 million tax free. That is not the case. And in many cases, it doesn't happen because they don't fulfill a series of financial ratios referred to as the qualified small business corporation rules. So when we do freezes and we have holding companies and things like that, we have to maintain clean companies. So we do things called purifications and all that kind of stuff to get passive assets out of, for instance, the holding company, because that's what's going to sell. So there's some degree of complexity. We work very closely with the accountants and have an eye 2 years out because that's our reviewable period. So that's something that's always critical. I don't see the general anti-avoidance rule too often. I mean, they've really beefed that up, but I still don't see it, and particularly in estate freezes. It comes down to valuations almost always. So you want to have your appraiser have some experience with these kind of things and then work.
Right. Okay. So Trevor, so what I'm hearing you say is this is complicated, but it's plain vanilla.
You got it. Yeah.
And if something's gonna go wrong, it's gonna go wrong in the valuation because they know you're trying to get the lowest valuation you can. Okay, so we deal with partnership buyouts all the time. Fair enough? Or
Exactly.
families having issues. So the way that we deal, and you want to get to a fair number, I like this formula. We get 3 appraisals. Now I got to write a few checks here. We get 3 appraisals. You take the outlier one out, either the highest or the lowest, and the remaining 2 you average.
Mhm.
Okay. And now I can say to any partner or any Revenue Canada tax auditor, look, dude, I got 3. I eliminated the outlier and I averaged the other 2. That'd be pretty hard to argue against. How many that's when we're dealing with partnerships where, but in this case here, would 1 appraisal, 2 appraisals, or 3 appraisals be better?
I prefer more. I mean, and I spent years in the actuarial world, and we always had, multiple data sources when we were doing valuations. So I like your way of doing it. And that the other thing is that if your lawyer is worth, anything, they're going to have a price adjustment clause in all of the documents, so that if CRA is going to challenge and it looks like they've actually got some metal to their argument, you've got a recourse, you've got a safety valve.
So the price adjustment
Clause
is important in a partnership.
Yeah, but it's
going to
be in the share attributes. It's in the shareholder agreement. It'll be throughout the freeze documents.
Just to throw a number, what percent, maybe it's hard to ask, what percent of estate freezes actually get reviewed?
I don't think it's too many. I think they're going after other stuff. I hear about them from time to time, but not on a daily basis.
Okay, so this is not a high risk transaction.
No, because the valuers they're following standard operating procedures. There's professional standards. So yeah, they know in this market you want to try to get a low number. But if you come in with your model, which is 3 valuations, all of which are on the lower end of the spectrum, you've achieved what you needed. So I like your suggestion, your way of doing it.
Okay, cool. Okay, so actually Trevor, this is going really well. I was concerned we get bogged down. There's lots of questions here. At the end, we'll try and come back to them. Okay.
Right.
We normally don't get this many questions. Okay. All right. So how do you avoid the pitfalls that occur in this?
It comes down to due diligence and a checklist, having the right professionals involved. So accountants do a lot of the heavy lifting, right? Along with the appraiser. So they're the ones who are going to be preparing the step memo. And then counsel will have done a lot of these. I mean, you're going to get corporate counsel who have done, they do, 1 a week to several a week, and it's pretty much rote. They have a very tight checklist. The documents are solid and also have, as I said, the safety valves built in. But you don't want to go to a neophyte, right? And a lot of the time, what will happen if I'm working with an accountant who has not done a lot of estate freezes, we don't want to make them look bad in front of their client. We'll bring in a team to do the set piece reorganization and then move on. And it saves the client money because the accountant and perhaps their counsel, they don't have to endure a learning curve. We'll come in and do it as almost.
Right. So I'm just curious, how does business come to your practice? Does it come from another accountant, or does the client come directly to you? Or
a little bit of everything. I mean, I've got a social media presence. I tend to be.
That's not for the faint of heart, by the
way.
No,
I mean, I'm an anti-tax zealot, right? So I get lots of people who think, and they're right, the taxes are egregious in this country. But despite my conservative positions, accountants know that I know what I'm doing. So I do get a lot of work from accounting firms, and then I'm getting direct from clients. I'm getting financial advisors sending me stuff. Because my standard joke is I'm a lawyer and I'm a former stockbroker, so that when I'm dead, I'll be buried face down, so I know where I'm going. I speak that lingo, and particularly I speak accountant. I talk to these guys all day. So we're able to move quickly, but in a comprehensive fashion, so the clients understand it. Because I ask them, I tell the client, and I say, listen, on the 3rd meeting, I'm going to ask you a question. Why are you doing this? You don't have to cite chapter and verse or sections of the act. They're going to know inherently. This is why I'm doing it.
Okay, very, very interesting. Okay, so what are the planning and strategies that should be considered post-freeze? So now you've done it, right?
So now you've locked
in the brain damage. Yep.
It was locked in the value. So mom and dad know that they froze the empire for $10 million, and they have a $2.67 million or whatever it is tax bill when they die, or the last of them to die happens. So what we're going to end up doing is we're going to do planning for both the common shares, or the growth piece, and the frozen piece. And that will involve a series of strategies. It often involves life insurance strategies. that mesh into the reorganization. And it comes back to, and we have a slide on this, the quintessential value when we talk about corporate estate planning is not death benefit or cash value or anything like that. It's all about capital dividends, and we're going to talk about that. But we end up with the freeze shares. So mom and dad have
Okay,
now.
so hold on, Trevor.
Go
Are
ahead.
you now referring specifically to this slide on the right-hand side?
No, I'm going to talk about that right now. So,
Okay,
so one of the standard strategy, and I was seeing clients yesterday. We just started implementing this, is that you now have these frozen shares. Now, what often happens, or almost always, is that the founding generation will also take back a class of shares. They're usually called specials, and they will have a nominal value of $1, but they have all the votes. So they, as I said, you never surrender control until you've assumed room temperature. So what will happen is that the value represented in those free shares, they're usually preferred shares, is they're going to start redeeming them. The company is going to start buying them back from mom and dad. Now, at tax, that's considered a dividend, but there can be tax attributes in those shares that's going to give rise to a positive tax result, as in paying less. So a wasting freeze is the standard strategy that occurs after mom and dad have frozen, because they're going to maintain control. What we are going to probably find is mom and dad come off of salary. We have other strategies that we can implement there, but they're going to go on to this redemption schedule where they're going to start receiving dividends. We usually insure the value or some of the value of the freeze share, so that if there is a premature death, we've created liquidity and capital dividend credits to do what we call post-mortem planning, to get rid of the tax or get it down to something tolerable, usually sort of 10 to 15% range.
Okay, all right, okay. So we have to go now a little technical here, right? We got to talk about what is this capital dividend account and why is it important? This is the most technical I think we're going to get in this session, right?
Yeah, I mean, because I didn't get into refundable dividend tax on hand, then people's heads will explode. Capital dividends, everyone in the real estate business knows what a capital dividend account is, because when you sell a capital asset, as you know, half of it is taxable and half of it is not. And the government had to step back from their verkacht idea of taxing it at 2/3 or making 2/3 of it included for taxation purposes.
So hold on, Trevor, let's just quickly define it here.
Yeah.
So when you get a capital gain, half of it there's no tax on.
Half of it's
on
no tax.
Taxed.
Right.
So it works out to about 27% somewhere.
Yeah, so the
25%.
The half that's taxed is it's a 27%. It will also create refundable tax that comes back to you later if you do the right steps. But the half that isn't taxed, that is a credit to this notional account called the capital dividend account. Capital dividends are paid out tax-free. That is the critical.
Hold on, Trevor, are we on the right slide, or do you have to go one ahead?
Oh no, we can use this.
Okay,
it's going to be in there. This is what happens if you don't do planning. But a capital dividend is paid out tax-free. So if you are in the real estate business and you are from time to time selling properties, you are crediting that capital dividend account every year. Usually the accountant's going to say, flush it, pay it out to the shareholders. It's tax-free money. The only other way that you create this capital dividend account is through permanent life insurance. So when a policy is held in the right corporation and it's paid out tax-free, and there's a calculation, basically it's a death benefit versus the cost base of the policy, just like any other property, that credits the capital dividend account. So when we do post-mortem planning, we look at a number of scenarios and financial planning modeling and all that kind of stuff and say, okay, we know that when mom and dad leave the earth, that there is a $7 million tax bill that we have to pay. We are going to go out and then place insurance that is going to create a capital dividend of at least that amount, so I can get taxed to between 0 and 15%.
Okay.
It's multi-staged. It's not that complex. It's math. But when we present this, we like to do it visually. There are a lot of schematics. We get up with a whiteboard and connect the dots. Tax planning is like Lego. You have to know what blocks to put beside each other.
Right. So Rod and Sarah, are you capturing these questions? Because I think it would be worthwhile to maybe do an email or summary back to everybody, because there's too many questions here to answer. And I think we're taking something that's fairly complex, boiling it down into bit-sized pieces. But these are good questions, but I think they deserve maybe answers that we can't just give online like that. Okay. All
Exactly.
right.
And
So
this slide we have up, I think, is important because as entrepreneurs, you should know what is double taxation, because most don't.
Yep.
So in Canada, we don't have an estate tax. The Americans have it. It moves around depending on who's in the White House. Canada's toyed with it, but we've never implemented it. What we have, and most people know the first leg of tax, which is this thing called a deemed disposition. So when you pass on, if there
wait a
is,
second, Trevor, are you on the right hand side where it says $10 million
I'm
real
on
estate
the
corp?
layer one, capital gains.
Okay.
So,
All right. Yep.
okay, so when a taxpayer dies in Canada, they're deemed to have disposed of all of their capital assets at fair market value. That gives rise to a capital gain. If their spouse survives them, there's a rollover, but eventually the spouse will pass and the tax is triggered. That's roughly 25 to 27%, depending on the province you're in. Now, what most folks don't realize is that a corporation is a legal person. And as a legal person, though it does not breathe, it will survive the shareholders. And in order to extract the value from that corporation, you have to get rid of it. You have to wind it up. At law, that is called a share redemption. So the shares are actually redeemed out of the estate. That is treated at tax as a dividend, and dividends range from, again, province, depending on the province, but in Ontario, 39 to 48%. If you don't do the planning, you pay both. Now, it's very rare that we run into double tax because folks are properly advised. They're talking to you and your team. They're giving me a call. We are putting in the right strategies so that we avoid that. But they should know.
Hold on, Trevor. If
Right.
someone doesn't do this, it's a disaster,
It's
right?
73%.
Like you're saying, right? No, I've seen people in the U.S. where they wind up, the family, some have gone to the U.S. and it's but they wind up paying a double taxation, and it's
Exactly.
brutal, right? And it could have been solved by planning.
That's
Just
it.
give the audience an example of where they've done it wrong, so it's understandable where they could be subject to double tax.
The founding generation passes. They pay the tax on the capital gain, and they do nothing. And then 5 years later, they realize that they want to pay out the estate, and they have to redeem the shares to do it. They trigger a dividend. You're outside of the technical timeline, and you get hit with both capital gains and dividend tax, and 73% of the value is gone.
Right. So why would that happen? There's a fighting family, and it takes 5 years to resolve it. And then when you finally get it resolved, you have this problem. That would be an example of what you could do.
That would be it. Yeah. So you want to have all of the measures in place long before mom and dad have passed along, so that and this is where I'm not here to sell life insurance, but this is where insurance gets implemented, because it creates the ability to redeem shares with capital dividends, subject to technical rules, and then carry losses.
I never understood that, I think, till now. Good. Very good. Okay, good.
There you go.
You want to do the example on the right hand side?
Basically, sure. This is, I mean, what will happen is we have in this case a $10 million real estate corp. We're assuming a very low cost base originally. So if you have death occurred, you have capital gains at 25%, 7.5% remain in the corp. And when you redeem the shares to distribute it out to the family, I'm using a blended dividend rate of 45. If you don't do the planning, that there's $4.1 million of additional tax that is paid, right? So you're now looking at near 70% tax. That's what we have to avoid. And there are tried and true section. Well, it's right out of the act, but there are rules we follow within 3 years of the death of the last to die, where we've implemented the planning, we've utilized capital dividends. And again, it's called a hybrid pipeline, and I'm not going to get into it today, but Derek, we get people down to between 10 and 15%, which is far tolerable.
It seems to me like, to understand this double taxation, which is horrible if it occurs.
Right.
Plan in advance, maybe have insurance, and make sure your timing fits. If I have to summarize what you said.
Yeah. Be properly advised. That's it.
That would be money well spent to make sure that doesn't happen. Okay, cool. Okay. I guess, okay, is there next slide? Okay, so Trevor, let's just summarize here.
We are not to, yeah, this is an hour. This slide would be an hour. We are not going to go through all of this.
Yeah, Trevor, really, you've done an excellent job here in terms of summarizing something complicated. It's into what's understandable. So let's just talk about what are the three I've forgotten everything you've said to me, okay?
Right.
What would be three takeaways? Let me go first, okay? This is what I've taken away.
Yeah.
Okay. From that, Rod, maybe go full screen because I think we're going to be done in
Yeah,
about 5 minutes. Okay, if everyone's planning. And yes, we are going to record this, and we're going to capture the questions. And Trevor, just see if there's maybe some feedback to do, or maybe there's part 2 to do of this. Okay, where we can get back into it. But we might have a minute for someone to come off mute and ask a question if they want to. But Trevor, here are the 3 things I've taken away. Okay, number 1, timing is good to do this. Okay, you
never been
want a
better.
depressed market. We probably have one right now, particularly I would say inland, right? Number 2, you need family engagement. Okay, who's on here? Carolyn Ennis is on here. My partner and Marco and Dave Price. We are always involved in family situations where people have not planned in advance, and it creates, forget about the tax problem, the family problem, the just so many problems, right? So this is just generally good advice. And Trevor, I'm going to use the put governance in place while you're alive. Okay. And Gen 1 is some hardworking schmuck, and he's working, all of a sudden he's up to $100 million. And he never thought he would be that big when he first started with him and his brother, you know what I mean? Buying houses and flipping them, whatever. And then all of a sudden it's grown this large company, and now you've got these problems, and you did handshake deals with your brothers and your cousins, and now you're in Gen 3 or Gen 2. So engage the family early. It will solve numerous problems for you. And the third part, Trevor, is that it does seem complex, but quite frankly, a lot of things I do are complex, right?
Yeah,
But
it's
when you bring in the right people, it's not your responsibility is not to understand everything. Who, not how. I do not need to know how you do an estate freeze. I need to know who does it and they're capable of doing it. Okay.
and the what.
So those are the 3 things I took away. I see my old friend Sean Murray here. Son of a gun, Sean. Yeah. Okay. Good to see you. Does anybody have a question for Trevor? We've got a little bit of time. This went way faster than I thought.
Eric, there's one that popped up that I want to answer because I saw it a few times. There's a perception that if you freeze that you're triggering a tax right now. No, you are not. It's one of the central reasons you do this is
that was my perception.
Freezing values, but you're deferring tax.
So I've got something, I freeze it today. I'm not writing a check today to freeze it.
No, some people do. For some occasionally they will pay the tax, but 99% of the time you are not paying the tax until you assume room temperature.
Okay. All right. Okay. Very, very interesting. Okay. Anybody got a question? Don't be shy. This is your big time. And Trevor's probably like, what, $1,400 an hour or something? So you can get them for on the cheap here.
$5 or $6.
Okay. Trevor, listen, this has been really good. I got to tell you that I thought this could really get a little bit out of control with detail and things like that, but it's been very, very valuable. And maybe Rod will consider doing maybe a second version of this or a follow-up version of this, or repeat this again. And Trevor, the next time we do it, maybe you can work some of these questions in here. Absolutely. They all seem quite different, but a few are about going from personal to corporate and things like that. So anyways, all good. Okay. Thank you very much for joining us. And we will see you at the convention December 2nd or January 6th at our next 2026 kickoff webinar. Okay. Thank you very much, everybody.
Thanks, everyone.